All right, credit default swap insurance. I think maybe I'll just skip over quickly. If you were a holder of mortgage-backed securities, you could buy credit default swap insurance. If they go bad, somebody pays you. So it seems like insurance, okay? But credit default swap insurance started to be used more to make bets that things would fail. So you could buy insurance that the securities held by somebody else would fail. Okay, and that's what John Paulson was doing. So they really became ways to make bets on the death of assets, on the death of firms, on the death of retirees. You can actually buy credit default swap insurance where you get paid if people die earlier than the actuarial tables say they will die. Okay? It's like taking out fire insurance on your neighbor's house. If your neighbor's house burns down, you get paid. Okay? Does that incentivize you to do something? Yeah. That's why you can't actually buy insurance to do that. But you can buy credit default swap insurance to do that. You could buy credit default swap insurance against countries. And there's one point where Warren Mosler, sort of as a joke, gave a bunch of us credit default swap insurance against Germany. That Germany would fail, and if they had failed, we would have paid a lot of money. Didn't. The key differences from normal insurance, you don't have...
You can bet against them, but as far as I know, there is a rule about if you bet against the US government, you get jailed.
No, you're betting against their bonds. Betting against bonds. Okay. The difference from normal insurance, you don't have to have any direct interest. So it really is like buying insurance on your neighbor's house. You don't have any direct interest in your neighbor's house. And the second problem, which turned out to be huge, you didn't have to have any reserves to sell the insurance. Now normally, if you buy automobile insurance, the automobile insurance company has to have reserves to pay losses. With credit default swap insurance, you had banks, say Goldman Sachs, sells credit default swap insurance, they have no reserves to cover the losses. Okay? The idea is Goldman Sachs then would buy credit default swap insurance. So they sold it and buy it, they're matched. Okay? They call that hedging. So the banks all thought they were hedged because they had sold insurance, but they also bought insurance, and as long as they matched it, it seems like the net risk to them is zero. The problem is a lot of them bought insurance from, anyone know who they bought insurance from? Very famous company, AIG.
Yeah.
And AIG had no reserves against the stuff. So when AIG went down, they would have brought down Goldman Sachs. So the Fed and Treasury work out a bailout for AIG. AIG directly pays all that money to Goldman Sachs and a handful of other big banks that had bought insurance from them against their own insurance they had sold so that they could pay out.